Welcome back. Davud Zervos of Jefferies joining us now as well. David, good morning. Good to have you with us. What explains the kind of reaction that we're seeing on the markets, even ahead of those? Good evening to you. Yes, ahead of those election results, David. Are markets, finding that Biden is well ahead because Trump is, alleging all kinds of legal action, and this could take weeks to play out?
It can go in a lot of different directions, but I think the markets are really keying off of what happened with the Senate and the fact that we're going to have a divided government here in the United States. I think that's much more of the storyline. There was a lot of worries, I think, about a blue wave, at least from my perspective, and I think that would have been a much more difficult thing for the market to deal with, even though everybody liked the fiscal stimulus idea. They were a little bit nervous about the regulatory powers and the taxation powers that might come along with that. So I think the fact that we have divided government, Republican Senate, the Democratic House, and whether we get a Democrat or Republican at the helm, that's going to just keep things relatively calm, I think, in terms of tail events that might have really shaken the markets. And those would have been things related to big regulation changes, big tax changes, which are not likely to hit the markets now.
Okay, that's interesting. So I see what you're saying in terms of a little less uncertainty in terms of any drastic policy changes happening there. What about the kind of inward-looking protectionist measures that Trump has really bandied about, even though some of the experts we were speaking to yesterday said that there was no actual corollary evidence of that having impacted trade flows so far. But given that that's been front and center of his policy, do you see a big relief on that front when it comes to China, the trade tensions, the dialogue on that side?
I think there's actually a pretty good EM story that develops generally. I don't want to get too specific about which EMs, but I think with Biden more likely to win now in the betting markets, I think a Biden win does bring with it some reprieve for the emerging market trade that was having a little bit of trouble over the past 3 or 4 years, particularly as it related to the way Trump had dealt with China. So yes, I think at the margin, investors should be looking to some of the beaten up emerging market credits under a Biden win that would be under less pressure in that scenario. So I think there is a story there. I don't know that it's a huge story, but I think it's an interesting story. I also think that if Trump were to win in his second term, I don't know that he would be as aggressive on the trade front. I mean, it was part of his campaign and was part of his legacy, but he's really fallen back in some of those Rust Belt states. That's where he's having all the problem. And what actually propelled Trump to be in contention was fighting against the more radical left. I mean, if you look at what happened in Florida, he picked up a Latino vote, a very large Latino vote, and really won big in places like Miami, not on trade issues, but actually on fighting what he likes to call socialism. And I think a lot of the South Americans and Central Americans and Caribbeans that live in Miami, that appealed to them given the countries they come from, like Venezuela or Cuba and the like. So I don't know that Trump's trade war played that well for him. So maybe even under Trump, a Trump win, you just see sort of less caustic emerging market relations when it comes to the economic side of the equation, at least.
David, if one works with an assumption that Joe Biden could be the new boss of White House, then two people who perhaps from a financial market standpoint they matter, Elizabeth Warren and Bernie Sanders. Do you think more than Joe Biden, we should look at individual portfolios? Because Wall Street knows Joe Biden. They know what Joe Biden is from last 40 years.
Well, I think Wall Street also has a pretty good idea of who Elizabeth Warren is as well. She's definitely made her mark over the years with the Consumer Financial Protection Board and all of the other things that came out of the financial crisis in 08 and 09. So I don't think she's an unknown commodity. Sanders a little trickier, obviously has not been given a big role in any of this sort of in the financial markets. But look, as I was saying in the previous answer to the previous question, I think something that played very well for Trump was his pushback on the radical left. And so I'm not sure that Biden, who's pretty much a centrist, is going to be jumping up and down to appease the radical left that much. And I think part of the reason the market is kind of embracing what's happening now is this election was a repudiation of the radical left and in many ways the radical right. So it was a much more move to the center. It was a move for a less caustic relationship between the administration and Congress and the Fed and other countries and the administration. So I think the storyline is really one where we took away a lot of these crazy fat tails and we have a more overall centrist storyline. And if Joe Biden were to go more radical, he has two checks against him that make it hard. He's got a Republican Senate and he's got a conservative Supreme Court. So if executive orders start to come through that threaten some of the regulatory reforms that have been rolled back on Wall Street, those might find difficulty staying with the Supreme Court, just like Trump's executive orders did. And you also have to get any new legislation through a Senate that's not going to be very happy with doing that. As well, I think maybe some of your viewers haven't noticed, the other thing that was quite interesting about this election was that the Republicans seemed to have picked up some seats in the House. So it really was a move to a more centrist Congress. At least so far, that's what it looks like. And a very, very close election still between Biden and Trump. So this idea that we were moving to a radical left-wing agenda or embracing a more radical right agenda is just off the table. And that, I think, is a sort of good news for the U.S. and good news for those who transact with the U.S. regularly via trade. It's a better outcome for all, I think.
Okay. David, before we wrap, now we can look at data which would tell you that Democrats have been good for Wall Street. I can slice the data and prove that Republicans also have been good for Wall Street. But looking at the lay of the land, which is that irrespective of who the next president is, who gets the Senate, who gets the House, we don't know. But US Fed is going to follow loose monetary policy. So do you think this liquidity infused market, which is going higher because of money printing, is going to move higher irrespective of what happens?
I am quite bullish on the equity markets and have been. We came into this without cutting our risk back because we didn't believe a tail event would be really in play. That said, I think you have to look at it away from liquidity provision and think of it as just, as economists, the way we look at it is just the Fed is going to keep risk-free real rates very low. So keeping your money in cash is just not going to pay you very much. You're going to have incentives to go out and take risk, whether that's risk in equities, credit, emerging markets, or the like. We're going to see the incentives for the private sector to engage in risk-taking activities, which generate risk-adjusted real returns on capital, risk-adjusted growth, and risk-adjusted job creation, real job creation. That's really what monetary policy is doing. It's not just money printing. It's an incentivization structure. And in many ways, I think that's the way we got out of the GFC, the global financial crisis in 2008 and 2009, was largely that. And the way that I think we're going to come out of the COVID-induced crisis, which may take more time as we plow through the difficulties with it. I think this is also how we come out with it. So I don't view this as some sort of reckless game. I view this as the appropriate monetary policy for the situation. We have very little inflation. We've missed our inflation target now for 8 years in the United States, even with a 50-year low in the unemployment rate, by many, many basis points, cumulatively over 8 years, something like 650 basis points of misses. We have plenty of room to miss on the upside. We have a new Fed framework, which wants to miss on the upside. So we're going to have loose monetary policy, and we're going to have a lot of reasons why your investor base out there that's watching this and our investor base in the U.S. are going to be out there looking at good risk projects to generate real returns on capital, real growth, real productivity gains, real job creation, all through entrepreneurial behavior, not through fiscal policies, not by the government picking winners and losers, but by the private sector picking winners and losers, which in my opinion is always a much healthier way for an economy to evolve.
Wonderful chatting with you this evening, David. It was great to get a sense from you. And as you said, starting to get a more centralized approach. It'll be interesting to see how the final result pans out. Thanks so much for joining us, and we look forward to speaking with you again soon.